More trouble for Robinhood after the platform announced plans to lay off 9% of full-time employees. This coming after the company saw an 80% spike in headcount between March and December of 2021. Joining us now to discuss is Mizuho Senior Financial Technology Analyst, Dan Dolev. Dan, more trouble or not more trouble? I mean, maybe this is the company trying to sort of rationalize or right the ship after what has been quite stormy seas, so to speak. What do you think here? Is this the right thing for them to do, and what else do they need to do?
Yeah, look, thanks for having me on the show. It's to be here. Look, very, very important on Robinhood is they went public. Let's just start from the beginning. They went public at the most, craziest, most exuberant time for trading, right? If you remember, you're going back to last year, Q1, Q2. So they definitely overhired. And if you look at their revenue, so we did some work last night. If you look at the revenue per employee stats, their efficiency stats, they're actually quite low, right? So they're in the high 400s. Their peers are 500, 600,000 revenue per employee. So they definitely overhired. They need to trim the employees. I mean, is it great news? Probably not. But does it bring them back to earth? That's probably the thing. So I think it's kind of back to, call it square one, and like making sure that this business starts to work in a non-COVID environment.
Dan, is Robinhood a public company a year from now?
Yeah.
Why would that be the case?
I don't have a crystal ball, but if it's not a public company, maybe it gets acquired. But I think Robinhood is here to stay, because everyone we talk to, this is a very, very good question. Everyone we talk to, and I talk to a lot of young people, their interface is better than everyone else. People love it. People that are on it love it. The interactions, right? The number of interactions per week, per month is light years above all the other apps, even the ones that we like, right? Even the cash apps, et cetera, that we like. So the business or the business is very good. What they're suffering from is just this post-COVID, hangover. Yeah. And it's very harsh, but it doesn't say anything about the fundamental value proposition of the business.
And that's what I'm getting at, Dan, because the platform it's slick, it works well, there's a lot of loyal people on that platform, but do you think it makes sense as part of someone else's portfolio where they can help perhaps scale it up even quicker and do it more efficiently?
Yeah, so if that's the question, I mean, again, I can't predict these things, but I think there's going to be definitely a lot of value in Robinhood. And I don't want to point out specific names, but there is, if when push comes to shove, if things really deteriorate from here, I think there's a lot of value in what they offer. Again, like the feedback that we're getting from people that use it is that they have the best interface. And I think that they've really invented something that, that their peers, the kind of the more sleepy peers, don't have. And they have a following. People like it. So it's a really good product. It just happens to have gone public right at the peak of the all-time trading boom.
I want to transition to some of the other companies that you cover elsewhere, because obviously there's a lot of news out today, and there's more coming from PayPal after the bell. Visa numbers looked pretty strong here, and it's interesting that you're getting some concern about economic growth, about cyclicality from some earnings reports. I don't really see that in these Visa numbers, right?
Not at all. And I think the results were good. Remember, I'm neutral on Visa, and we actually downgraded Visa earlier this year. If you think about the results from Visa, they're very strong. I don't take anything away from it, but it's mostly driven by the comeback in cross-border revenue, right? Which has been sort of the number one factor. If you remember kind of the economics, the way Visa makes money, the take rate or the yield on cross-border is a 10x factor versus the normal. So if they get paid 10 cents on a regular transactions when you go to Starbucks, or 10 basis points, so to say, then they get paid 100 basis points if you go to Starbucks in a different country, right? So it's a massive increase in the take rate. So because people are traveling, I was in Europe, I'm sure a lot of people are traveling, spring break, post-Omicron, people are traveling, bookings for the summer are strong. This drives a lot of revenue for Visa, a lot of high margin revenue, which is great. And it's amazing. The question is, how sustainable is it once you lap it? And the key question that we're asking is the strength of the U.S. debit business, which is what's subject to account payments, Fed now, long term. I'm looking at these things long term, and I think long term, Visa isn't as strong as it was, or the moat is not as strong as it was, say, 5 years ago. But still, it's a great trade. I don't take anything away from it.
Dan, when you're out there talking to clients, is there any sense that they are about or nearing a point where they're going to step in here and buy some of these beat up fintechs on weakness? And then secondarily, why have we seen this weakness in the space?
I call this FIFO, but not the FIFO you think of. It's first in, first out, but not from an accounting perspective. Payments, and we've actually done work on this. This is an excellent question, by the way. Payments has been one of the early beneficiaries. I'm talking as a sector as a whole. Payments has been one of the early beneficiaries of the COVID trading boom, right? You mentioned Robinhood. Think of like where PayPal was back in like early, 2020, et cetera. So because they've seen such a, mountain of growth, the lapping of these comparisons on a 2-year stack basis is very harsh. The work that we've done, we've looked at, 75 to 100 payment stocks versus other stocks in tech. What you're seeing is that the 2-year stack, i.e. the growth this year plus the growth last year on a quarterly basis, is the number one predictor of stock performance. If things stay the way they are and they're actually looking better than what we would have thought, you're going to see a massive snapback in expectations in the second half, and the 2-year stack reaccelerates, which means that all these payment stocks are going to do extremely well in the second half. So I think the buy side is waking up to it. I think what you're seeing today is probably the beginning of it. I'm very bullish on payments. First in, first out. They were the first to benefit, they were the first to suffer, and they're going to be the first to benefit in the second half.
And so super quick, Dan, you would include PayPal in that thesis.
I'm bullish on PayPal on the business. I'm bullish on the brand. I think they've got issues. I'm worried about the checkout button. You saw what happened with Fast, right? Which is like the one-stop shop checkout. I'm worried that this space is becoming hyper competitive, and I worry about this management's ability to kind of reinvent itself. So I'm bullish on the PayPal brand. I just think it needs maybe someone, to take a comprehensive look at how you kind of re-energize that brand. But it's an amazing brand, right? I mean, it's a true global online e-commerce network, just like Visa and MasterCard are for, credit and debit.